Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of bull versus bear markets, what they mean and how to navigate them. How bull and bear markets affect investments. Bull and bear markets affect more than just market sentiment. They shape the performance of investments across different asset classes, influencing how portfolios grow or shrink. Understanding these impacts can help investors navigate challenges and spot opportunities. Impact on stock investments. The effect of bull and bear markets on stocks is impossible to ignore. Stocks are often the most visible reflection of market trends, and they react strongly to shifts in sentiment, economic conditions, and investor behavior. During a bull market, stock prices generally climb steadily, often spurred by optimism about the future. Companies see increased profits, which in turn drives higher valuations. Investors feel more confident, leading to higher demand for equities. More buyers means greater competition for shares, driving prices even higher. Broader participation. Retail and institutional investors actively seek growth opportunities, expanding interest in both established companies and riskier ventures like startups. Market momentum. Positive cycles emerge as rising prices attract more investors, creating a self-feeding upward trend. In contrast, a bear market creates a much tougher environment for stocks. Prices drop as investor confidence wanes, dragging down even solid companies. The downward pressure leads to decreased valuations. Stock prices may fall below their intrinsic value as fear overtakes logic. Flight to safety. Investors shift focus to less risky assets, selling stocks en masse. This often amplifies the decline. Lower trading activity. Uncertainty keeps many investors sitting on the sidelines, waiting for signs of stabilization. For long-term investors, this volatility can feel like a roller coaster ride. However, it's important to remember that bear markets are often temporary and can offer buying opportunities when prices are low. Impact on other asset classes. While stocks often dominate the conversation, bull and bear markets influence other assets as well. Bonds, commodities, and alternative investments all react differently to changing market conditions, making diversification crucial. Bonds. In a bull market, bonds typically take a backseat. Rising stock prices and strong economic conditions reduce the appeal of fixed income investments. Yields may drop as demand slows. During a bear market, bonds often act as a safe haven. Investors flock to them for stability, driving prices up, especially for government bonds. This inverse relationship between stocks and bonds highlights their balancing role in portfolios. Commodities. Commodities, like gold and oil, behave uniquely. During bull markets, demand for industrial commodities, e.g., oil, copper, tends to rise as economic growth accelerates. In contrast, bear markets can push investors toward precious metals like gold, which are viewed as a store of value during times of uncertainty. However, falling demand in other sectors may hurt prices for raw materials tied to manufacturing and construction. Alternative investments. Alternative assets, such as real estate, private equity, and cryptocurrencies, are influenced by sentiment and liquidity. In a bull market, increased risk tolerance often leads to higher investments in these areas, especially speculative ones like Bitcoin. Bear markets test these investments, particularly those with limited liquidity or high volatility. Real estate may face pricing slowdowns, while speculative assets could see sharp downturns as investors retreat to more stable ground. Each asset class responds differently to market conditions, meaning there's no one-size-fits-all approach. Diversification across these classes can help protect your portfolio when the market takes an unexpected turn. Psychological effects on investors. Markets aren't just numbers and charts, they're deeply tied to human emotion and behavior. Bull and bear markets bring out unique psychological responses that influence decision-making, often amplifying market trends. Understanding these effects can help you navigate emotional pitfalls and make rational choices during both upswings and downturns. Investor behavior during bull markets. Bull markets are often fueled as much by emotions as they are by solid financial fundamentals. When prices keep rising, optimism becomes contagious, and investors are quick to adjust their strategies to chase gains. Here are some common psychological patterns that emerge during bull markets. Optimism takes over. Investors tend to believe the good times will last forever. Rising prices reinforce confidence, leading to an expectation that they'll continue climbing. This optimistic outlook can make people more willing to take risks, often without recognizing potential downsides. It's similar to driving on a sunny day. Everything feels easier, so you naturally pick up speed. Higher risk-taking. In a booming market, many investors throw caution to the wind. Confidence in future returns overshadows the need for careful analysis. This mindset often leads to speculative investments in startups, cryptocurrencies, or other high-risk opportunities. The fear of missing out, FOMO, can also drive risky moves that aren't grounded in solid strategies. Herd mentality. When everyone is making money, it's hard not to follow along. Bull markets thrive on crowd behavior, where individual decisions are heavily influenced by what others are doing. If a stock is making headlines for its rapid growth, people rush to buy, even if the valuation doesn't make sense. The "if everyone's doing it, it must be right" mentality creates bubbles that are vulnerable to bursting. While optimism and risk-taking can lead to significant returns during a bull market, they can also cloud judgment. Investors might overlook red flags or pay too much for assets, setting themselves up for trouble when the market slows down. Staying grounded and sticking to a long-term strategy is crucial to avoid getting swept up in the frenzy. Investor behavior during bear markets. If bull markets feel like a party, bear markets are the day after hangover. When prices start falling, fear and uncertainty quickly take over, creating behaviors that can make downturns even worse. Here's how investor psychology typically plays out during these periods. Fear and panic selling. Falling stock prices trigger fear that losses will spiral out of control. Many investors panic sell, liquidating their positions to stop the bleeding. This cycle often exacerbates declines as widespread selling pushes prices even lower. It's like yelling, "Fire," in a crowded theater. One person's panic spreads to everyone else. Emotional decision-making. Fear clouds rational thinking. Rather than focusing on long-term goals, investors often make emotional decisions driven by the pain of losing money. This could mean selling solid assets at a loss or avoiding opportunities that seem too risky, even if they're fundamentally sound. Risk aversion. While bull markets encourage bravery, bear markets bring out caution. Investors shift from growth-focused strategies to wealth preservation. They might move their money into safer assets, like bonds or savings accounts, and delay re-entering the market until the outlook improves. This aversion to risk, while natural, can mean missing out on eventual recoveries. Bear markets test investors' resilience, but they also offer opportunities for the disciplined. While fear pushes many to the sidelines, those who stay focused on fundamentals can find undervalued assets and position themselves for future gains. The key is resisting emotional impulses and remembering that bear markets, like all periods, are temporary. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.